Hey there, welcome to the first month in review video. As I shared in the Santiago synopsis over the last couple of weeks, I've been contemplating moving from a weekly, which I haven't had a chance to do just because of sports and life, to a monthly recap. And I think the monthly cadence is going to be better. Also, I like the idea of not focusing on headlines every single week because that's not necessarily the best thing for us to do when it comes to investing in our plan anyways. So I think once a month aligns better with my beliefs on how we should be handling the headlines. Obviously, if something crazy happened, I would reach out to all of you beforehand, but we're going to roll with every month. So beginning of the month, I will do a recap of the past month, talking about some headlines you may have heard, breaking them down as I always have, and making sure we understand how these headlines may or may not be impacting our life plan, financial plan, and portfolio. So let's get to October. Now, October brought a mix of resilience and uncertainty. We had a government shutdown, slower growth, strong markets, rate cut from the Fed. So let's dive into all of those. No particular order. I did leave the Fed for the end, but little spoiler alert there. But we'll dive through, and we'll first start off with the government shutdown. So you are aware of this by now. Over 900,000 federal workers were furloughed, and we are still running the clock on how long this government shutdown is going to last. Both parties blaming each other. I don't know whose fault it is. It is frustrating, though, to see that we can't have our leaders come together to figure out some things to keep things moving. Obviously, understand this is bargaining power on both sides, and hopefully this will get resolved soon because there are government workers who are now beginning to miss their paychecks. For a while, it's okay. They were still paid, but now that we're missing paychecks, this is going to cause some harm and some discomfort for some people. Not that we want to use other people's pain as reminders, but this is why we have emergency funds. Whether it be a government shutdown, loss of employment, injury, disability, or something like that, having some money to bridge a gap is very, very valuable and important. So this is just the reminder, and if we can take a lesson from something that's not ideal, that's good, rather than learning the lesson in the moment. So this is why we have those emergency funds. Obviously, emergency funds run out. I'm sure a lot of these people who are furloughed have those, but we don't want those going so long that the shutdown going so long that they run out of their emergency fund. So one of the I won't say it's a problem, but one of the things that the government shutdown has also impacted is when it comes to our investments in Wall Street. We haven't been getting the government reports like the labor numbers and things we're used to getting. So right now, Wall Street is operating not necessarily blind without the normal information that they usually get. So that is another reason that at least the investment world would like to see the government get back against, amongst all the other reasons, is getting us data on how the economy is really doing rather than us piecemealing it through what companies are saying and ADP is saying and other things. So I do think we get a good understanding of how things are, but we're missing those key reports that often create headlines that we talk about from week to week and now month to month. So that is a little bit of the government shutdown. There was the World Economic Outlook by the IMF showed that global forecasts are declining. So that is just showing that the global economy might be slowing down a little bit. Not a lot. The forecast was 3.2 for 2025. Now it's 3.1 for 2026. So it's not as if it's a big slowdown, but something to pay attention to. And from an investment standpoint, this year, especially early in the year, the non-U.S. investments were the ones that were doing better than the U.S., something we've been waiting on for years. We talk about diversification, have globally diversified portfolios. In the last 15 years, it's almost been like, why do I have international? 2025 was the year for international to finally remind us why we want to be in there. And now we're seeing that maybe economies are starting to slow down. Inflation is still above the target in a lot of those areas. So by no means a crisis, but it just shows that the global economy might be slowing down a little bit. Not a good thing, not a bad thing, to be determined what happens, but just something to be aware of, especially as we are global investors. Over the month, the markets did really well. Usually, fall is not the best time for the markets. September is typically ugly. October oftentimes starts out ugly, recovers towards the mid to the end, and hopefully we get a Santa Claus rally like we have the last few years. But markets stayed strong. So the S&P 500 is doing very well. The Dow is doing well. The NASDAQ is doing well. A lot of it being right now, the belief is being powered by all of the money going into AI and spending with AI. So while October's great month does not necessarily mean November and December will be good. As we're seeing today, as I record this on the 4th, the markets are having a red day, which is not a big deal, but all tied to reports of AI. So AI spending, are AI companies overpriced? You hear people talking about bubbles going back to 99 and 2000, all of these things. And at the end of the day, those things become noise. We are not immune to those stories, but also as globally diversified portfolio holders, yes, we have AI, but we have all the other stocks as well. You have exposure to thousands of companies. So what happens to a Palantir or an NVIDIA or even an Apple? Yes, it will be in your portfolio in some regards, but it's not as if you are riding on only those companies. So just good to know that the markets have been doing well this fall. Expectations are, or what the street is projecting and people are thinking, and maybe it's just wishful thinking, hoping for, is that the year will continue to finish out strong as well, and we'll roll into 2026, and we'll see what next year has for us. So to be determined, but markets did well in October. Also in October, the Senate voted to roll back global tariffs on over 100 nations. So tariffs were coming back. The tensions there got a little spooky for a moment between us and China, but President Trump and President Xi got together, and it was all around rare earth exports. And it seems that there has been at least an agreement or moving forward in a more diplomatic way. So trade and tariffs will keep on coming back up until who knows when. But that was another headline that came up in October, midway through October, shook the markets a little bit, and then things kind of worked out. And we're just seeing the negotiations continue as we have in the past. Labor market weakened. So again, we don't have all of the great numbers, but it looks like growth is slowing. Unemployment ticked up a little bit, and layoffs increased in a few sectors. So this is all off of other notes. This is off of data we got before the government shutdown. So it's it's not up to date, but it is giving us an indication of where things were already trending anyway. So right now, the economy still, at least from the jobs, still is doing well. You're having low fires, but also low hires is the kind of buzz around the CNBCs and the Wall Street Journals of the world. So all in all, it still looks strong, but we're seeing some weakening. So obviously something to pay attention to. And it's also something the Fed's going to pay attention to. Finally, the Fed, as I mentioned, they were going to bring us up in the rear. Fed cut rates again, 25 basis points. So now the range for the Fed funds rate is going to be 3.75 to 4%, but we hear them talk about 3.75 because that's where the cut starts. So another quarter basis point, but the language coming out of the meeting, which is what a lot of people want to pay attention to, is that there's no guarantee we're going to get another cut the rest of the year. When those comments come out, the market doesn't like it. The market likes lower interest rates. It's better for borrowing. It's better for growth. But also, it's the Fed is supposed to remain independent of what the markets want and what the government wants and do what they think is best for us. Again, their target is inflation 2%. So they're looking at inflation numbers. They're looking at employment numbers. They're looking at wages numbers to come up with how are they going to handle the next rate cut. So to be determined. A lot of people are making the case that rates should be lower. There are just as many people making the case that rates should be exactly where they are and they shouldn't cut. So these cuts end up in the short term being a very short term headline. Markets react to what happens. Markets react to the comments, digest this information, set new levels, whether they be up or down, and then we move forward. So if the Fed were to come in December and not lower rates, the market may not like it initially, but then it's going to get back to looking at things and continue to move forward. Other data points to show that the economy is still doing well, if it is, and move forward. So I don't think we want to make investment changes around what the Fed may or may not do because we don't know. And also, as we've been taught many, many times over the last few years, just because we think the market should do something and it makes total logical sense, it doesn't mean that it should happen. You look at this year's returns in the market coming off of last year's returns. This is not a normal market follow-up. Having the S&P and everything up a lot last year and being up again this year is not normally what happens. It's not what was expected. And you throw all the headlines in there as well and all of the global events that are going on. It would be very easy to make a case that we should be flat for the year or down, yet we're up double digits on most of the indexes. So that just all goes back to the belief of diversified portfolio with your risk tolerance tied to your goals, and then not reacting to the headlines, because there's always going to be a headline. There will always be a reason to sell. And in the moment, it may seem real, but in the long term, it probably is just a blip on the radar. And a little bit of investing involves having faith that everything will work itself out as it historically has, having faith that people are generally good over bad, and things will move forward despite these momentary headlines and shocks to the system sometimes. So that is everything that I thought was relevant. Obviously, there was tons of headlines over the course of the month, but those were the things I thought were most important that I wanted to digest that you probably heard about. And at the end of the day, some of those were good, some of those were bad, and the markets did very well in October. So you're never going to know what's going to happen. Stick to the plan. Don't make drastic changes. We make sure that we have everything we need for the short term in more conservative areas and ready for us to use. We let the growth engines grow, rebalance. Things we've been doing, if you're a Santiago or RLS Wealth client, we've been doing for 10 plus years here at the firm, and some of you beyond that as we work together at firms prior to me starting the company. So at the end of the day, these headlines may or may not be impacting your life plan, financial plan, and portfolio. Most of the time, they're not really impacting over the long term. That is the theme of these videos, but it's always good to remind you. So with that, that wraps up the first of the monthly videos. I will be back December, beginning of the month, to rehash what happened in November, which I cannot believe it is November. So as always, I want to thank you for tuning in. If you are watching this inside the synopsis, look down below, a lot of great content below. I started sharing some of my Align Life Substack, which is a place that I'm writing specifically about money and looking at money from a different lens. Those are all in there as well. So a little bit more reading for you if you're interested. If not, the boys' pictures are always at the bottom, which is what I know most of you really care about. So with that, I will let you get to your day. Thanks for tuning in. I'll be back next month. And until then, keep pursuing.